So this question is from Kevin about how we value companies and how we decide when to sell. And he asks, do we rely on certain key ratios, or is there another approach that we use? And do we tend to use target prices, and how do we derive these? And what do we do when a share reaches its target price? So going around the table on this, what are your thoughts, Maynard?
One idea of valuation is just to buy above average companies at below average multiple. That's one way of investing. I don't use price targets, so I can ignore that part of the question. I use basic measures such as PE, yield, and net asset value. So for PE, I make sure the earnings are backed by cash flow. So if you have price to cash flow, sometimes your cash flow there's ups and downs in the cash flow because of working capital movements one year versus the next, or big capex expenditure and not so big in the next year. So if you make sure the earnings are backed up by cash flow over 3 or 5 years, I just use the PE for that. I've looked at complicated valuation measures before, like DCF or sums of the parts. I can never get them to work. The more clever you are with valuation, sometimes the less likely the value actually exists. So I think it's hard to go too wrong with buying respectable businesses or above average businesses, modest PEs or below average PEs. I mean, anything single digit PE in a good company is usually worth looking at. I think the message is keep it simple. If you look at something like Hargreaves Lansdown, which we've been talking about today, that was priced at 40 times earnings a few years ago. Now it's 12. You look at the measures of the company, the margins and ROE, it's definitely a much better business than average, and it's yet trading on what is a modest below average multiple. They're the opportunities you should be considering.
Bruce?
Yeah, I agree with that. There was a lot of science that went into bank valuation before the credit crisis. People doing very complicated things of some of the parts valuations and DCFs. And I just think the more complicated the model is, the further away from common sense you are. And actually, you want to be pretty close to common sense when you're doing investing. That you can use a sophisticated model to justify doing stupid things if you want to, but it's much harder to justify doing stupid things with a very simple model. And the one thing I would say, though, is it does pay sometimes to think about normalized margins or normalized PE. So you might have one particular year or some investment spend, for example, over a couple of years. And you say, actually, we're at the bottom of the economic cycle and bad debts are very high at the moment. But what would a normal year be? And how much would I be prepared to pay? So, for example, this would be Frontier Developments at the moment, which is loss making. But I don't feel like that's a normal year, that normally Frontier Developments ought to be making a profit. The business has plenty of cash. I think be very surprised if they burn through their sort of 20 million or so of cash over the next couple of years. So I feel like at some point this business will generate a normal level of growth and a normal margin. And on that basis, it looks quite cheap, below £2.50.
Mark, how about you?
Yeah, so interestingly, like price earnings ratios tend to work, and they tend to work because they're a shortcut for a DCF. So if you do the maths of compound an infinite series and add it up, mathematically, it's identical to a price earnings ratio. And like Maynard says, in there are some assumptions like over the long term, cash flow is equal to earnings. So like Maynard, I tend to look at that cash flow. I tend to look at that is a realistic assumption, particularly for things like if a company is making ongoing repayment for a pension deficit or other factors, I will adjust for them. And being a bit more deep value, I also look more at kind of book value, tend to like discount tangible book value. It's a little bit like Bruce does with normalized earnings, but you normalized by the fact that a business has assets and these assets are either productive or not. And if they're not productive, there's a massive pressure to make them productive. So often I'll buy things either that are very cheap on earnings, and then I don't take a lot of risk in the future. If I'm buying something on 3 or 4 times earnings, I'm not taking a big risk. Or I buy at a big discount tangible book value with the assumption that something might not be cheap on earnings at the moment, but the pressure on management, the force of capitalism will mean that they will shut down unprofitable lines, they will refinance the business, they'll do all the things that to make those assets productive again, or somebody else will come in, buy the company and do what's necessary to make them productive. I think the question is a bit more about when do we sell, so that's a bit like valuation. I think selling's a little bit more nuanced. So I tend to sell too early. So I'm surprised how quickly a business goes from being viewed as an incredible business by the market when the price is high to a truly terrible business when the price is low, and back to an incredible business or a reasonable business when the price has recovered. And I'm always a little bit too early to sell. I get nosebleed at a P of sort of 12 to 15, and often then in a bull market the stocks go higher. So controversially, I try and look at a bit of momentum as well. So with particular earnings momentum and a bit of price momentum, I try and hang on that little bit longer than my instinct is. So what do you guys think about selling? Is there anything in there that's to do with selling?
I've got the opposite. I tend to sell too late. Just hold on. So selling is more nuanced, I think, and you have a gut feel in terms of a lot of companies are seemingly expensive, but they just keep on getting expensive because they're pretty good. You're never going to 10 bagger by just selling out a 50% gain. That sort of. I recognize that I'm not that good at selling, so my strategy is to buy good companies and hold them for the long term, and maybe sell or top slice when things are obviously deteriorating or there's a much better opportunity somewhere else in the market. So that's my basic strategy for selling. I don't have price targets or anything like that. It's a bit of a gut feel at the time. I guess it's try and make fewer better decisions on the buying, and that makes the selling a little bit easier where I'm involved in good companies and I can hold them for the long term because the management are building the business for the long term as well. That's my view on selling, which perhaps may not answer the question, but that's what I do. I don't think there's any sort of strict formula for selling either, or even buying. It's a lot of it is just your intuition and just what your own experience, and you've got to learn for yourself a lot of this, when to buy and sell.
Yeah, I think it's fair to say, personally, selling well has always seemed to be a bit harder, possibly, than buying well, certainly sometimes. Bruce, do you have any kind of rules of thumb or approach you use for selling?
Yeah, I sell very often because I like the nature of the things that I try to invest in are quality compounders, which by and large, they might tread water for a couple of years, but you do hope that they would keep going. So it feels like it's difficult. Once you've found something that's 5 bagged or 10 bagged or 20 bagged, you feel like you want to sell because you feel you want to recognize the gain, but you also have in the back of your mind that you have to find something else that's going to compound away.
I was going to say, I have a slightly controversial view over multi-baggers. I think it's easier to find, say, 3 shares that double and therefore give you an 8x return than it is to find a single share that's going to do 8x. And that means I end up being partly the type of things I invest in, but I end up being more active than perhaps the rest of you for that reason. Is I'm just not very good at finding those multi-baggers. I'm much better at spotting a short-term valuation anomaly and then hoping it corrects in a reasonable amount of time. But it shows that there's lots of ways to successfully invest in this, and it's about finding what fits your skill set and your temperament, I think, in this.
Absolutely. I'd echo that you need a process where I'm completely comfortable to see the value of my portfolio halve of a paper loss, and that doesn't bother me at all.
I don't think I look out for companies which are going to 5 bag or 10 bag. I just buy companies which look attractive. You hold on, and then after a few years, oh, look, they have 3 bagged. And then you hold them for a few more years, and oh, look, they have 5 bagged. So some of the biggest winners for me are companies where I'd never thought they would 5 bag, but they have. It's just because they've done a lot better than I expected, and I've held on. But yeah, I mean, if I'm looking definitely for 5 baggers, I'm going to really struggle because you just take far too much risk in companies which probably never 5 bag.
To some extent, because I feel that actually there are quite a lot of things that I've invested in which I've thought were low risk on a dividend yield of 5% and seem to be trundling along. Then something happened. I wasn't actively looking for 5 or 10 baggers. I just held on to them for 5 years, and good things happen, good companies.
Yeah, I think that's probably the key thing we're all saying, really. We're looking for companies that are doing something that's reasonably attractive now. You're not hoping for something to fundamentally change. You're just looking at a business that is generating a reasonable return and a reasonable amount of cash and is reasonably valued. And that way, it's a lot easier to sleep at night like that, I think, than waiting for something transformational to happen or depending on something transformational happening to get your return.
I would caveat that obviously my strategy is a bit more like buy something that is rated as if it's terrible and expecting something positive to happen at some point. But I'm very careful on balance sheets. I want a balance sheet that's pretty rock solid. I don't mind debt as long as it's long term and it's secured. But I want that kind of thing that, okay, this could survive a couple of years of poor trading. If it's trading poorly now, it has to survive to see that upside.
One possible way of looking at selling price prices is to compare the current share price to your perhaps buy price. So in the past, I've held Tristel shares, and I'm thinking I buy these shares at, let's say, £1, and look at the actual share price and it's £6 or something like that. And you think, hold on, I would only buy these shares if they'd fall like 5, 6 from their current price. Maybe that is a sign for selling. And sure enough, they're now £4. But yeah, so maybe compare your valuation in terms of selling to what you'd buy the shares.
Yes, that's, you mean whether you'd buy the shares now rather than
buy the shares.
Or buy price was.
Yes.
I think your buy price is obviously completely irrelevant to returns, and most people would be better completely forgetting that. It ends up being a sort of bias, but that's a really good point. If you start with a blank sheet of paper and you wouldn't buy that stock now, well, why are you holding it? And you might hold it for momentum and then say when the momentum fades, I'm going to sell. But that's a really good strategy.
And it's probably worth saying, if you're holding good quality things, it can be quite testing. We were talking about Fever Tree, so that's always had good quality metrics, and the shares hit a peak of somewhere around £35, I think, in 2018. And arguably, the business still has some attractive qualities now, but the shares are down by about 2/3. And so someone who got in early and did very well, there's no right answer, I suppose, as to whether you should have sold them at an earlier point. But it's certainly something that people have to work out what they're trying to achieve and what they're comfortable with.
I think with a lot of companies in the last decade or so, I mean, you've sold out thinking this is expensive. It's just gone up and up and up. And then the tide turned and you're left stranded. Different market conditions now. I think having invested for more than 20 years, you do see, in terms of you valuing a company, you do see market crashes and lots of despondency from time to time in the market. So 2003, 2009, 2020 in March, you thought widespread market crash and shares were pretty cheap in those occasions. I would always look out for those sort of opportunities or opportunities like that in individual shares where everyone, I suspect, around this table has bought a share and think, well, it can't go any lower than this. And it goes lower. And you think, well, I'm buying more. And it still goes lower. Look at Lion Trust. We said last time it was bonkers cheap. It's still down another 10% from then. You think it's even more bonkers cheap now. You never know how despondent the market gets. And if you read through history about market crashes and how despondent investors get, that's where the obvious value appears. And it's just there waiting for you to buy. It's just whether you've got the conviction to buy at that time, or whether you've already given up.
This is probably a dangerous statement, but I think the current markets look even better value than 2020, March 2020, because in March 2020 there was a massive amount of uncertainty. It's like governments stepped in and shored up various businesses. Pretty much every business was cancelling the dividends. If you were a dividend investor and you'd based your returns on the dividends will be paid, even if the capital return isn't there, pretty much every company went, we don't know what's happening. But it wasn't didn't necessarily not have the cash. It was so much uncertainty. They all just cut the dividends. You didn't know what asset prices were worth. Were pubs going to survive? There was so much uncertainty. And yes, the outlook is potentially bleak for the economy, has a number of challenges today, but the level of uncertainty is nowhere near as big today. And some of the valuations, I think, are getting in the same ballpark.
I would agree with all of that. As I said at the start, I didn't realise Hargreaves has got down so cheap in terms of its valuation. So you could argue a little bit about the business, but it's a great business and forecast at 12 times earning 6% yield. People would have bitten your arm off for that sort of valuation a few years ago, and here it is now. So I think there are lots of good companies at modest valuations in the moment.
At the end of the day, there's always something to worry about, and that's really part of what creates opportunities for us as well. It's the people who leave all the cash in their investment accounts. That's where all that interest is coming from. It's not cash savings products or money market funds, is it? It's the people who are just sitting on it and doing nothing.
So there's a wall of money about to plough into this market.
Or else be withdrawn.
Maybe.
Possibly.
Yeah, just to be clear, that is not financial advice, and none of us really know what's going to happen in the short term in the market. But I think you can make the argument that things are cheap out there. Well, that's it for this time. If you enjoyed this episode, please do consider supporting our podcast through a monthly subscription. That way, you'll get to keep the podcast going and help us remain free of adverts and sponsors. That link again, pipod.co.uk. Thanks for listening and goodbye.